I want to ask you about your outlook on the
Good to talk to
economy
you, David.
because recently as a couple of weeks ago, you said that it's going to be rough. We're going to come back in the second half. We may have unemployment as high as 15%, mid-teens, something like that. Have the recent developments changed your views on that any? Do you think it's any worse than it was before?
I think it's basically, my view is basically the same as it was 2 weeks ago. I think we're going to have a substantial contraction in the second quarter. And we've said publicly annualized as much as 25 to 30%, but again, that's annualized, so multiply by 4. We think we'll start growing again in the third quarter, and we will continue to grow into the fourth quarter. I probably would say today that peak unemployment may be closer to the mid to high teens, so maybe a little higher than I'd said before. And we still believe that we'll end the year with an unemployment rate something like 8 or 9 or 10%, but in that range. And the challenge going into 2021 will be to work that unemployment rate down.
So there seems to be a range of views among Fed presidents as well as the board, which is why you have multiple people, so you have different views and they're expressed. But if you take Mr. Bullard on the one hand saying it's going to be a sharp V, and you have Mary Daly now saying, boy, this could really drag into next year in a recession, where do you put yourself on that spectrum?
Here's the worry. Here's the challenge. Going into this situation, we had sluggish manufacturing, sluggish business fixed investment. Obviously, a lot of it had to do with weak global trade. But the one thing we had going for us as an economy is we had a very strong U.S. consumer. We had a low unemployment rate. Household balance sheets were in reasonably good shape. And that was 70% of the economy. The challenge is, as we come out of this later this year, and if the unemployment rate really is 8 to 10%, you're going to have a weakened consumer who's going to, you would think, save more, be more careful, be a little bit more reluctant to spend, and that's going to be a headwind for the economy. And it may take a while, and I mean into 2021, for the consumer to get his or her footing back. And I think that'll be dependent on how quickly we can run down this unemployment rate to lower levels. So do I think it's going to be a V? I think the consumer situation makes me think that we'll have a recovery, and it'll be a solid recovery in the second half of the year from the levels we're at. We're still going to have a 4 to 5% contraction for the year, but then the question will be, what's the pace of growth, and what's the state of the U.S. consumer? Those are the questions, and that's the issue I'm most worried about.
And the psychology of the U.S. consumer, it strikes me, is not simply being somewhat more conservative because they got burned in a downturn, but also being concerned about their personal safety. How willing are people going to be to go back out, even when they're allowed to do it, to go to restaurants, to go out and spend, to really participate in the economy? Will there be some reluctance just because of personal safety concerns?
Yeah, so there's 3 levels of issue with the consumer. One is personal safety, as you mentioned. This is why testing, ubiquity of testing, is so critical. If you had widespread testing at scale, I think that would do a lot to give consumers confidence to go into the workplace, to go out to restaurants, to go into other public gatherings. But that's very much dependent on how available is rapid testing. The other 2 issues are job insecurity. I just saw a survey from the New York Fed that said something like 70% of all workers are worried about their jobs, about losing their jobs. So there's that insecurity. And then the last issue is just what's happened to the consumer financially, and particularly that segment of the population, which is sizable, that doesn't have much savings and lives from paycheck to paycheck. And this is going to make it so they're even more cautious. So those are the 3 big issues that affect the consumer.
As we look at the models that you all run at the Fed, is it likely this pandemic will actually affect the potential growth for the United States? I mean, I think before it was probably around 2% more or less. Does this take that number down somewhat going out into the out years?
Yeah, it may, and so we'll have some snapback growth in 2021. We'll grow faster than potential next year. We'll grow at a higher rate. If potential is 2%, we think we're going to grow a lot faster than 2% because we're making up for what happened this year, But after you get into the future, there's two things that drive potential growth. One is growth in the workforce, and the second is growth in productivity. And the concern I'd have is you have a number of people that are going to lose their jobs and are going to have to find new jobs. Some of them who are older, it's possible will decide to retire, i.e., just withdraw from the workforce. Others will need to get retrained. Some will find it hard to find other jobs. So workforce growth, as we're running down the unemployment rate, you would expect a good rate of workforce growth. As we run that down, though, we had a workforce growth issue coming into this because we're aging. Demographics were such we already had a workforce growth challenge, and we're going to have to relook at that, and that means job training. It also means revisiting a sensitive subject, immigration, appropriate immigration, ways to grow the workforce, and then the second issue is productivity, and I've talked a lot about that here at the Fed. The U.S. going into this lagged the world in math, science, and reading. We ranked 25th out of 35 industrialized nations. And while we've beefed up skills training, we also are not doing it fast enough to keep up with the changes with technology and technology-enabled disruption. So, and you also worry about, will the level of government debt squeeze out some private investment in CapEx? So we're going to have to address all those issues, and I know we can, so that we can grow faster. But otherwise, yes, potential growth could slip. And we already thought going into this crisis, we were concerned that potential growth was going to erode over the years because of those drivers I just talked about.
How much could it slip, do you think?
Well, my concern, if you talked to me in January, I would have said that potential growth in the United States maybe is 1.75% to 2%. And what is that made up of? Let's say 0.5% in workforce growth, and let's call it 1.25% to 1.5% growth in productivity. If we still got to address the workforce growth issue because of aging, and so that hasn't changed. And then the issue is productivity going to get better or worse? And so we already thought in January, if you'd asked me, that over the next 5 years we could see potential growth slide from 1.75% to 2% to closer to 1.5% to 1.75%, heavily due to demographics, by the way. And then the question in our minds was, could productivity improvements make up for it? I've still got the same concern.
Let's talk about specifically your district, because it's right in the middle of the oil patch. The oil industry is really taking it really on the chin right now. Give us a sense how you evaluate the effect on your district and the economy in your district, not just from the producers themselves, but also all the service providers and things like that. There's a lot of jobs involved in oil exploration and development.
So the oil business and related businesses is roughly about now 9% of Texas GDP. That might surprise people. But over the last 25, 30 years, the state has grown dramatically, and we've diversified into a number of other industries. But even with that percentage, 9%, this is as everybody knows, extremely difficult time for the oil business. Why? The price of oil is down dramatically because of oversupply, and it's not economic for a lot of producers to produce. So what they're doing is they're shutting in production. They're stopping production. You'll see a number of failures in the industry. And people just can't make it through this. And then for the service providers, they're obviously suffering because there's less production. And so we even before this crisis had expected CapEx in the energy sector to be down 10 to 15% this year. It's going to be down dramatically more. And obviously there's going to be job losses. The big issue in the short run, though, is even though when you look at your screen, you see the quoted price of Brent and WTI West Texas crude, the local price is even lower. And why? Because we've got so much oversupply, we're on the verge of running out of storage. And so if we actually fill up the storage where there's no place to sell the product, you'll actually see the local market prices being well below the quoted market prices. So that makes it even worse for producers, where they just can't make a profit at these levels. And that's where we are right now. Now, after we get people back to work and we start to resume appropriate consumption, some of this excess is going to take several months to work off and into next year, and then you'll get to a more balanced market. But right now we have an extraordinarily imbalanced market, and that even takes into account the recent deal between Saudi Arabia and OPEC+. It just wasn't enough to overcome the huge amount of daily oversupply we have right now.
There's a limit to what the Fed can do to address that. Is this a time for fiscal intervention? And it could be either out-and-out bailouts, or now we have reports that maybe the government's thinking about essentially paying producers to keep the oil in the ground, sort of a strategic petroleum reserve in the ground. Do things like that make sense?
Well, I'll leave it to the fiscal authorities to make those decisions. The point of it is we're getting to the point where there's nowhere for the production to go. There's dramatically reduced demand, and there's nowhere for the production to go, and so I could see why the government is considering incentives to encourage producers to produce less, because all it's going to do is fill up the tanks faster and cause the price to plummet even further. So this is an extraordinary situation. It'll eventually work itself through, particularly once we get the economy back turned on. But in the near term, I talk regularly to people in the industry. They've never seen anything like this, and because they've never seen the demand destruction that we're seeing. So I could see where extraordinary steps to keep those tanks from being filled up could well be appropriate.
The Fed has done an awful lot already. It did last week. It took a lot of people's breath away. What's next? I mean, we've had now Nancy Pelosi, the Speaker of the House, suggest maybe there should be loans made to mortgage tenders, to things like nonprofits and things. Would you be in favor of expanding out the lending facilities to other sectors?
So what's going on right now at the Fed is we're standing up a number of these facilities. So we've announced a number, and a number are already up and running. And some of them have been announced but are not up and running. So we're furiously working around the clock here at the Fed to get a number of these facilities set up to where money is being dispersed. Then beyond that, to your question, we're continuing to look for pockets of the economy that have been overlooked in what we're doing, and through no fault of their own are under stress. And so I would say my own mindset would be we should be open-minded about continuing to look for areas, whether it's nonprofits would be a good example. The issue of mortgages, mortgage servicers is something obviously that's under a lot of stress. What our goal is to have appropriate market functioning, and the other thing our goal is to keep intact to the maximum extent possible businesses and nonprofits that went into this healthy and only are under stress because of this situation, and we would like to do what we can to help them come out the other side and continue to function. So I think in that vein, I'd be open-minded about what else we might need to do.
Which takes us exactly to a really challenging point, that so-called moral hazard. The ones who came into it healthy through no fault of their own, they're under stress, as opposed to some who came in not so healthy. Sometimes you have to bail out both. You have to help both just to get this through it. Are you concerned about the moral hazard, and how do we come back off of that and return to a world where you are rewarded for prudence and you're not rewarded for the opposite?
So I am concerned about that, and that's why on the corporate corporate bond program, we've sort of set a cutoff of I think March 22nd, March 23rd. If you were investment grade on that date, you're in the program. So that will include some fallen angels, i.e. companies that were investment grade but have been downgraded. We have said that we will buy high yield ETFs, but that's going to be in relatively small size, and it's intended to help market functioning. But yes, I am concerned about, from the Fed's point of view at least, intervening in help in businesses where they were leveraged going into this, and we are taking action in those cases. I think that's really an issue for the fiscal authorities to decide, and that's really their judgment. I don't see that being the Fed doing that.